Hey, everybody. Welcome. This is our episode of Financial Aid series where we talk about ways to make college more affordable and easier on your wallet and also on your overall state of mind. Because, getting our kids into college is hard enough, paying for it is even more difficult, and it often takes a toll on parents and your kids as well. So, we want to talk about things like financial aid, scholarships, loans, tax credits, and more, all so that you can send your kids to really good colleges without having that stress and without having the financial stress, for you or for them for years to come. So, if paying for college is in your future, then stay right here for money saving tips that you're not going to get from Google or from high school counselors, and unfortunately, not from colleges themselves. In case we haven't met, my name is Roman Polnar. I'm a financial aid expert and your host for these financial aid series. And today, I want to talk to you about how middle and higher income families can get relief to pay for college. I just did a training for a group of middle and higher income families and helping them come up with a plan. And we learned a lot of really interesting things in hearing their questions and also hearing some of their concerns and their frustrations about not being able to get financial aid. And so, what I'd like to do is share some of those things with you because I hope that they are really going to help you find the money that you need to send your kids to school. And if you've got a college bound student, this is a perfect time. If you know somebody in your personal, in your family, or the professional network that is talking about how frustrating it is to find money to send their kids to school, let them know that this is here because I want to share some of the highlights with you about the financial aid alternatives that we talked about in our training. Like I said, the training was really squarely focused on those middle and high income families and helping them come up with a plan on how they can pay for college when they didn't qualify for enough of the traditional financial aid. Because if you're in one of those two income brackets, then you're just not going to qualify for enough traditional financial aid. And it's unfortunate, but that's what it is. It's not a question, and it's not really much that you can do about it, or any of us can do about it, unless we fundamentally change the financial aid system. But if you're in one of those middle to higher income tax brackets, or not, excuse me, not tax brackets, if you're in one of those middle or higher income brackets, then unfortunately our system is set up that way that you're just not going to be able to get enough financial aid. And that's why we talked about the alternatives. More specifically, there are three big alternatives beyond the traditional financial aid so that those folks can get more money to send their kids to good schools without having that financial stress, and certainly without having to take on more debt. Okay, God knows we don't need any more debt. And so that's what we talked about. And, one of the biggest questions that came up was, well, how do I know, what income bracket I'm in? And so I want to quickly talk about those income brackets, and you can use these as a rule of thumb. Now, obviously, there are no two people exactly alike, right? Our kids are different. The colleges they're looking at are different. Your personal finances are uniquely different. They're all so different. It's like a unique fingerprint. But there are some rules of thumb, no pun intended. So let's talk about them right here. Generally speaking, if your income falls below $50,000 a year, it's safe to assume that you will qualify for a meaningful amount of financial aid. I'm talking about the traditional need based financial aid. If your income, on the other hand, is above $300,000 a year, it's also safe to assume that you will not qualify for any traditional need based financial aid. And if you're like most people in this country, where your income falls somewhere between those two ends of the financial aid extremes, right? What if you earn somewhere between 50 to $300,000? Well, then you will qualify for some amount of financial aid. But the amount of financial aid that you may qualify for will depend on where you fall on that income range. Because as your income goes up, well, your eligibility for financial aid goes down. And so when I explain this to people, right, the next logical question in their mind is, okay, so will we qualify or will I qualify for financial aid? Because where on that spectrum between 50 to 300,000 do I fall and how much should I expect? And so this is where I wanted to take a step back and help you better understand what the traditional financial aid is and how that works so that you can better estimate or better aim for the right amount of financial aid that you may be able to get. So, the traditional financial aid that I keep talking about is also known more technically as need based financial aid. And it's effectively based upon your family's financial need for financial assistance. And it's really decided primarily by a government formula. And that formula looks at your income, it looks at your savings, and then it decides how much it thinks you should pay for college. Now, that number that it thinks you should pay for college is called your expected family contribution. And you'll commonly see it listed as EFC. In the next 2 years, by the way, the expected family contribution is going away and it's being replaced by something called the Student Aid Index, SAI. Is there a big difference? No, there isn't. Why is there a change? Thank you, government. They just decided to make the term different because they thought that the expected family contribution was misleading. And in their brilliance, they thought that student aid index was going to be more clear. Go figure. Um, there really aren't many changes beyond the name. So you can continue thinking of this as the number or the amount of money that the government will actually expect you to pay for college based upon your income and your savings. And that's what they're going to expect you to pay actually every year. And this is where I told people the wheels start coming off of this financial aid bus because the government formula is flawed. It does not work like it used to many years ago when it was first created, and it hasn't been brought up to the present in the way that it should have. It's flawed, it's out of date, and it's just wrong. But it's the only system that we right now have. But it's flawed because it usually overestimates how much people can actually pay for college. So, for example, I talked about a family of four with an income of $150,000 a year. Now, this family, based upon the government's infinite wisdom, is going to be expected to pay about $120,000 for college. Now, most families with an income of $150,000 would have an expected family contribution of about $30,000. Again, depending on other factors like the age, the amount of savings that you have, the state that you live in, your EFC might be a little different. But as a general rule of thumb, a family of four with an income of $150,000 a year is going to be expected to pay around $30,000 a year. So you multiply that by 4 years and there you get the 120,000. Well, the challenge is that most families who earn around $150,000 were not able to save $120,000 for college. The average amount of savings in the US that families have set aside for college is around $25,000. Right? Because you've got other expenses to pay for. You've got your housing, you've got, put food on the table, other education expenses when your kids are still little. You still have to save for your own retirement. You take a vacation every now and then. I mean, it's expensive to live, especially if you're in some of these more higher cost of living areas. And an average family earning $120,000 or $150,000 just can't easily save as much money as they need, for the government to pay for college as much as the government thinks that they can. So as a result, there's something called the middle class squeeze. You can look this up online, but the middle class squeeze effectively is where families' average incomes have not kept up with the average increase in college cost. So there's if you look at the what's called the consumer price index, right? That's the measure of inflation. And we're all experiencing this right now like we haven't in the last 40 years. Everything is tremendously more expensive and we feel it. Not just see it, we feel it every single day we go to the store. Wherever you buy anything, you go to the gas pump, you can see the difference. It hurts. Well, that level of inflation is something called the consumer price index. It's the cumulative, or the I shouldn't say cumulative. It's the average increase in price of the most common household goods and services that average families consume. It has stuff like, housing and energy, food, transportation, medical care, education, cars, clothing, toys, TVs, stuff that we all buy, right? And these different things increase or decrease in price over time, year over year, at different rates. And so the average of all of those different categories is what's called the consumer price index, the average inflation. Well, the fastest rising the fastest rising good or service of all of the things that the consumer price index tracks, and it's part of what's called our inflation, is bar none, second to none, college tuition. It's the fastest rising cost of all the things that we spend money on, and it's been this way for the last 30 years. Well, our income and our savings on average have not gone up nearly as much. So, cost of college over the last 30 years have gone up about 170%. That's just in the last 30 years alone. Whereas average incomes have gone up about 50%. That's roughly 3.5% per year, or 2.5% per year, excuse me. So the cost of college is so much higher than the income and the savings that there's this now big gap between the amount of money that we were able to save and the amount that colleges want us to pay. And so, since the government formula hasn't kept up with these changes, they're still looking in the rearview mirror thinking that an average household family can afford a lot more than they can actually afford. And that's why the amount of student loan and student debt has skyrocketed just as fast as the cost of college. And when I talk about student loans, it's not just the money that kids are borrowing, it's also money that you're borrowing as parents. As of right now, the total amount of debt outstanding for college is exceeding $1.8 trillion. And 7 in 10 people have student loans. That number is growing at $3,000 a second. And I mentioned this in our training, which was about an hour long, that in the hour that we spent together, $11 million worth of debt would have been taken out by families just to pay for college in that 1 hour. And average student will borrow about $39,000 a year, and their parents will do about the same, which is actually a lot of money if you think about it. So when you consider that a family of four, in our example, earning $150,000 was expected to pay $120,000 for college, well, that's why they take on an average amount of debt of 80 grand. And that's a lot of money. It's the kind of debt that's very difficult to get rid of. And you're seeing this now in the press all the time. How there's a lot of talk about canceling some amount of student debt because young people are literally drowning in debt. That's why kids who graduate college have to take crappy jobs. They cannot go into the careers that they've always wanted and be patient, slowly build up into the career that they want because they have to start paying those bills. They also can't buy homes. I mean, price of homes have skyrocketed in and of themselves, but when you've got extra debt, they can't do both. They can't even qualify for mortgages because they've got the student debt that is being considered by all these lenders. They're also taking longer to get married and have kids because they feel like they can't afford it. It's tragic. I mean, I know that parents want to get their kids into these great expensive schools and they think taking on debt is worth it because it's going to give their kids a head start in life and it's going to set them up in some positive way. But that's not the case. If your kids end up graduating with debt, it's actually setting them back in life. They should be starting their careers without debt and doing all the things that they should be doing and they can't because they've got this debt. And that's exactly what I wanted to help everybody avoid. And that's why we talked about the financial aid alternatives. And I'll mention them briefly right now. Because in addition to and aside from the traditional need based financial aid that has been or that was designed initially about 60 years ago for middle income households, it was designed to help middle class folks afford those maybe higher cost colleges by bridging a small gap between the amount of money that families earned and colleges cost. And so for most people 60 years ago, paying for college was something they can do out of pocket and with some amount of minimal savings. But since then, as colleges increase their prices so much faster than average incomes, then there began to develop this bigger gap. And so families needed to dig deeper into their savings and more into their income to try to pay for college. And at some point in the 80s, they completely lost the ability to do it. And that's where the government came out with student loans. They've been renamed different things, but the government started lending money for college around the 80s. And since then, as soon as the colleges figured out, well, we can just keep increasing prices that families can't afford. But hey, the government's going to give them money. There's no pre-qualification. It's not like getting a traditional loan where you have to apply and you have to prove that you can pay it back. And then, they're going to do some underwriting to make sure that you're not borrowing more than you should. The government just gives you money. If you say, I need it to pay for college, they'll just give it to you. And colleges figured this out pretty early on. And they said, well, this is awesome. We can just keep increasing prices and people will just figure out how to pay for it. And as time went on, through the 90s and early, 10s and now in the 2020s, guess what? Colleges have just been exponentially increasing their prices, and so have the student loans. Now, I don't want to paint a picture to say that colleges are evil. They're not. A lot of them are still non-for-profit, but they're still, financial organizations. And yes, they do have higher costs as well. Like salaries that they need to pay to teachers have gone up. Yes, they need to update their buildings and technologies. But you know what? A lot of colleges have also put money or invested money into areas that really did not deliver better education. Like the quality of education is the same. The experiences are different now. Yeah, they've got big teams. Excuse me, big sports teams. They've got nice facilities. They try to do all of these things from an experiential perspective that are awesome. They're fun. Of course, why wouldn't we want our kids to have that? But look, at the end of the day, you're sending your kids to school to get an education, not to be at Club Med. And unfortunately, that's a lot of what it's been. And so as long as the government keeps doing this, college families will have a harder time bridging that gap because then they just can't keep up. So anyways, financial aid is now no longer providing the kind of assistance that families really needed originally to pay for college. Now there's a big gap, and middle and higher income families just don't qualify. And so we talked a lot about scholarships. We also talked about college savings, that's money directly from colleges. And we also talked about various tax savings as an alternative way to help bridge that gap between the cost of college, your average incomes and savings, so you don't have to borrow. You don't have to go in debt. And so I briefly want to just run through these to help you get a better sense of what I meant. So for scholarships, I want you to know that there are really three big sources of scholarships. They work a little differently because scholarships from government generally are reserved for the lower income families. But there's a lot of money from the government. In fact, the government has the largest amount of scholarships of all three categories. The second biggest category of scholarships are directly from colleges. And then the third smallest amount is from private scholarships, foundations, families, corporations, organizations, nonprofits, etc. But interestingly enough, contrary to common belief, scholarships are not just for those who are most talented or most gifted or the best athletes. Only 1.3%, less than 1.5% of all students who got scholarships actually got athletic scholarships. It's a very small percentage. And only 4% of all kids who got scholarships had really high GPAs in that 3.5 to 4.0 range. The reality is that the majority of kids who got scholarships, 30% of them had a 3.0 to 3.4, and a smaller amount got scholarships even if their GPA was below 3.0. And despite the fact that only 6% of all scholarships came from private sources, there's over 1.7 million private scholarships that have a combined value or worth of $7 billion. That's with a B. And to be exact, it's $7.1 billion. It's the latest statistics that I saw. So if you're in that middle to higher income family that doesn't qualify for traditional need-based financial aid, look at scholarships because there's a lot of money out there. But I want to forewarn you that if you are a lower to lower middle income family that is depending on and can actually get need-based financial aid, be careful with private scholarships because they can actually reduce your need-based aid, and in most cases they will. So be mindful of that. Now, the second area that we talked about were savings directly from colleges. And this is a really interesting area, and it's huge. You just got to look for right colleges. And I often tell folks in our training programs that the biggest mistake families make is that they don't look into these colleges and really understand how they give money and whether they actually have any money to give before their kids apply. Because once your kids fall in love with the school, it's going to be really hard to get them to change their mind. And as a parent, you feel like you're breaking their heart and you wouldn't want to do it. But the reality is that colleges give a lot of institutional aid. That's money that they have in their own reserves for a variety of reasons. Some money is for families that have a financial need. So this is not going to be money that comes from the government in form of loans or in form of work study where your kids actually have to work for it. Money that comes from colleges directly to fill your financial need is always debt free. In other words, it's free money, it's cash, grants, scholarships, it's all the same. And they use this formula to determine whether you qualify. So when you're looking at those higher priced, expensive private colleges, don't get scared away by the sticker price because it's not about the sticker price. It's all about how much you're going to end up being expected to pay out of pocket and what your need for financial assistance is. So the formula to figure that out is you take the total cost of 1 year of school, that's cost of attendance, or COA. You'll commonly see that when you're looking at colleges. And the cost of attendance takes everything into account. It's your tuition, room and board, books, supplies, fees, meals, etc. And you subtract from that number your expected family contribution, the amount that colleges and the government expect you to pay. And that determines your need for financial assistance. So if you have a need, right, based upon that very simple formula, then you want to look for colleges and have your kids apply to colleges that actually give 100% of the money that you're going to need. Not all colleges have money to give you at 100% of the amount that you need. So make sure you find them before your kids apply. The worst thing that can happen is your kids apply to colleges that have bad financial aid policies. They get accepted and you get a big bill and you freak out thinking, how are you going to ever pay for this? And you then start trying to get financial aid to only realize the college doesn't have aid to give. So do this before your kids go to college. And by the way, I want to mention that if you have questions, reach out, put questions in the comments, and go to freemoneyfirst.com. That's www.freemoneyfirst.com. And that's where we have our college planning group where you can get a roadmap of all of the things that I'm talking about lined out step by step. And we actually help you find those colleges that have money. So if you want some help, you want to find colleges with money, or you want to find money with other areas outside of colleges, check out that group. And I think you're going to really, really enjoy it. And you're going to get a ton of value. But more importantly, you're going to get really good results very, very quickly. And you'll get the money that you need. Now, colleges also give money for merit. Now, this is not merit for just, again, those extraordinary, athletes or extraordinary scholars or extraordinary musicians. It's all about a good fit. Colleges always look for good, diverse incoming freshman class. Some colleges look for more, boys or girls, East Coast, West Coast, North and South or Central. They're looking for, kids studying and going into different majors. They're looking for all sorts of things, and you want to find colleges that give money for kids that are a good fit. So find those schools. And then lastly, this is a really big one, is that some colleges just give tuition discounts for no reason other than the fact that they know that they're not expecting you to pay the sticker price. So if you have a good fit student, they very well will likely extend a discount. There's a study that I shared with our training folks that, according to the most recent tuition discounting study done by a nonprofit called NACUBO, 359 private nonprofit colleges they surveyed gave an average of 54.5% of tuition discounts. Think about that. These are expensive private colleges that automatically gave a tuition discount of 50%. Just because these were good fit students. So apply to colleges that have tuition discounts. Again, if you want some help, join our Inner Circle study group, and I'll tell you exactly how to do this. And then the last area I'll mention are tax savings. There are really two sides to tax savings for college. One are educational tax credits. This is where the government generally will give you a credit on your tax return if you're paying for college. It's literally free money from the government. It's awesome. So if you owe whatever you owe, imagine the government saying, nah, don't send us a check for that much. Send us a smaller check because we can see that you're paying for college. So we're just going to cut your tax bill. That's really cool. And then the second area of tax savings is just what I call the good old tax savings. It's how do you minimize your tax bill that has nothing to do with college, has nothing to do with education tax credits, because this is for those families who have higher income, who don't qualify for those tax savings or tax credits. It may be for families that own a small, closely held business. You've got a lot of opportunities for your or with your business to qualify for more tax savings and perhaps shifting some income into a lower tax bracket. It also applies to people that have stock options or stock grants through their companies, or maybe they just have investments that they had been investing in, saving and growing, and knowing that you were going to use them to pay for college. Well, if you're in a highest tax bracket or approaching a higher tax bracket, when you sell those investments, you're going to pay a lot of capital gains. And if you can shift it to your kids, then they sell it in their own names. They're going to pay less tax and they're going to qualify potentially for some of those tax credits I've been talking about, assuming they use the money to pay for their own college. Now, this stuff gets a little bit more nuanced, much more personalized, and it requires that you talk to a tax professional or your financial advisor. So don't take anything that I'm saying to you as personal advice. I'm giving you some food for thought. But these are the kind of things that we talk about in our inner circle community. These are also the kind of things we talk with families that work with us one on one, because now we're then able to actually get the full financial picture about their life. And we're giving them very specific, tailored personal advice. And right now, I'm talking to a lot of you on whatever media you're watching or listening this to. So please don't take this as personal advice, but take this as food for thought. Take these as ideas. And you can always reach out to us and talk more specifically, or you can reach out to your own advisors and talk to them about it. But if you qualify for any of these tax credits, don't miss out. It's easy to do because if you don't know that they exist, you just miss checking the box. And the government's not going to come to you and ask you if you're paying for college. They're certainly not going to tell you what to do to qualify for those tax credits, but they will give you the tax credits if you apply for them, if you qualify for them. And it's free money from the government. It's the best deal that there can be. I've never heard a person complain that government is sending them money back. Again, these are all very personal, nuanced things when it comes to tax planning. And so I also want to leave you with the note that hiring your kids, shifting income, shifting assets, all of these things that you can certainly do because it can help you lower your tax bill. But these things will also hurt your eligibility for need-based financial aid. So aside from and in addition to talking to your financial folks, if this is right, you absolutely want to consider this with somebody that understands financial aid as well, because you don't want to get some tax savings only to realize that it's offsetting the same amount of financial aid that you could have qualified for, which really leaves you no further along and no better off than you were before you started. So before you do any amount of work in figuring out how to structure your finances, or what area of the financial aid world to get money from, or what things you should do to actually get that money. How do you apply? Where do you apply? Which forms do you submit? Which colleges should you be looking at? Before you do any of that, just make a plan, which is what I started with. That's what we helped families with, is make a plan that works for you and your family. How are you going to pay for college? How are you going to get money to make that process easier, more affordable, less stressful, less dependent on debt? Make a plan. And so that's the biggest thing that I want to leave with you is, before you do any of this, make a plan, make a roadmap with all the things that you have to do, put them in order, and then start executing on that so that you're not wasting any time, you're not wasting energy, and you're not wasting money, which is easy to do if you are doing things that are outside of your sort of understanding and control. Because this financial aid stuff is complex, and it's easy to like step on these expensive landmines and make expensive mistakes. I made it myself when I was going through college, which is one of the reasons I'm so passionate about this and helping other families avoid making the mistakes that I made, because they were easy to make. They would have been easy to avoid had I just known. So anyways, with that, again, I just want to say, if you want to get that roadmap, um, reach out. We'll be happy to give it to you either one on one or join our inner circle community. And we provide that to you along with a personal website where you can actually start inputting all this data. And the formulas are so advanced, and the website is so advanced, the calculators are so advanced, it's literally going to start giving you directional guidance on where you should be looking for money and the things that you need to do to get it. So it's as simple as it can get. It costs a little bit of money, and so there is that, but it's certainly worth exponentially more, or it has exponentially more value, because you're going to get exponentially more money if you do those right things. And so we're happy to help. We're also happy to continue helping you do this on your own at no cost, if this is what you prefer. So keep learning with us. Keep signing on every week. I do this every Wednesday, and you can always reach out through our website, which is pillar6college.com, and we will help you in any way that we can. So without further ado, I'm going to sign off. I've taken up about 30 minutes of your time, which is the most that I try, or the longest that I try to do these episodes. I hope you found this one helpful. I hope it will help you make some good progress towards getting your kids into great schools and being able to pay for it with ease, and really enjoy this next few months or years that you've got ahead of you in helping your kids get through college. So thanks again. Thanks for listening. Thanks for watching, and we'll talk again soon. All my best to you. Take care.